Currencies, what every Forex trader should know. This is Phil Gunn, your presenter for today. We'll be starting a session very soon. Just 2 minutes for our friends to join us. Once again, thank you for joining us on our live webinar on how tariffs move currencies, what every Forex trader should know. I'm Phil Gunn. I'm a senior sales manager with Philip Nova. In today's webinar, we will be discussing on the topic of tariffs and how it impacts on the market recently. And also we'll be looking at how you can conduct the Forex trading on the MT5 platform. Before we begin, I would like to do a sound check. If you can hear me, just type yes into the question box. Also, during the webinar, if you have any questions, do feel free to type them in the question box. I will address all the questions at the end of the session. Okay, it looks like everyone can hear me. Let's begin today's webinar. My name is Phil Gunn, the speaker for this webinar, and I have been with Philip Nova for 15 years now, since 2008. I hold a dual license in futures and stocks, and I'm also an account manager to help clients trading in futures, Forex, as well as in stocks, with understanding the product and market by providing coaching and economic information to make proper trading decisions. Well, tariffs has been a headline for the past few months and likely to persist into the rest of the year. As such, the US may be entering a period of more frequent and potentially more persistent supply shocks, which poses a difficult challenge for the economy and also for the central banks. Today, we'll be discussing how these tariff-related supply chain disruptions could lead to lower growth and higher inflation, and how this is going to impact the currencies. Throughout the webinar, as I said, if you have any questions, just feel free to type them in the question box. My facilitator will arrange them and let me know. I'll answer them at the end of the session. This webinar itself will also be put up later on YouTube, so for you to revisit if you have the desire to do so. Okay, let's get right into it. Today's agenda is on Forex trading, and these are the following topics that we'll be covering. We will touch on the Forex trading in MT5 first, and then we'll discuss on the tariffs impact on the currency markets. At the end of the session, I'll be doing a demo on a MT5 platform so that you have a look at how the platform feels like. So first of all, the introduction. Forex market is a very huge market. The average traded volume is about 200 billion daily. Forex is traded over the counter. What it means is all transactions are conducted electronically and not over the exchange. The counterparty are banks that are spread across various financial institutions across almost every time zone. There is a gap when the US banks are offline and Asia takes over. That's around 4 a.m. to 6 a.m. in Singapore time. Liquidity is lowest at this period of hour, and this should be avoided. Since there's no centralized exchange, it is not transparent and others are filled according to the prices that the banks provide. Forex is always conducted in pairs. It is basically an exchange rate between two currencies. For example, euro-dollar. You are speculating on the strength of the euro against the US dollars. A view that the euro will strengthen will result in the actual value of this rate to increase. Let's take the analogy of exchanging money at a money changer. Say that the euro-dollar rate is at 1.09. This means with €1, you can change it to 1.09 US dollars. If you're going to go to the money changer with 10,000 US dollars and change it to euros at this rate, you get 9,174 euros. Later on in the future, when the rate increases from 1.09 to 1.11, you decide to change it back to US dollars. Now, when you change it back, the 9,174 euros back to US dollars, you will get 10,183 US dollars. Hence, you make a profit in USD from this exchange of currency. However, instead of going to the money changer, you use Forex contracts instead. You can avoid the physical money exchange and speculate just on the exchange rate number alone. So you simply make an online trade to buy a contract size of 10,000 instead at an exchange rate of 1.09. Subsequently, when the figure rises to 1.11, you can close the contract and make a profit when it rises. Hence, you buy at a lower rate and sell at a higher rate when it rises. Compared to money changers, the advantage of using the Forex contracts instead of physical money is the spread provided, which is very tight on the Forex market and can be as low as 0.6 pips spread. As compared to money changers, the spread is about 50 pips. So frequent transactions is possible with trading on the Forex contract market. Next, we look at the basic fundamental factors that affects Forex trading before we touch on tariffs. So the first thing is the economic indicators such as GDP, employment rates, inflation, interest rates, etc., that plays a significant role in determining a country's economic health. Changes in these indicators can have direct impact on a nation's currency value. Traders who understand and analyze these indicators can anticipate currency movements better. Next, interest rates and central bank policies. Central banks typically influence currency values by setting interest rates and implementing their monetary policies. Traders need to stay informed about central bank decisions, statements, and policy changes, as this can impact currency values. For example, higher interest rates can actually attract foreign capital and strengthen a currency. For example, the Federal Reserve has been leading the way in raising interest rates previously, having a tightening of more monetary policies as opposed to loose monetary policies. This resulted in the strength of the dollar-yen as BOJ maintained their negative interest rates. But of course, now the situation has reversed, and the rate has the Fed has actually decided to embark on a slow but surely reduction of interest rates. Next, we look at the political stability and economic performance. Political stability and economic performance are intertwined. Political events such as elections, government policies can have a profound impact on the country's economy and the currency as well. Traders need to be aware of these geopolitical movements and understand how political stability or instability for that matter can affect currency markets. Of course, the third factor is risk management, which is quite underrated in most of the time. Fundamental analysis helps traders assess and manage risk. But by understanding the factors that drive currency movements, traders have to implement these risk management strategies to protect your investments. So this includes setting stop loss orders, diversifying your portfolio, and adjusting the position sizes based on the market conditions. In conclusion, mastering Forex market requires a holistic understanding of the fundamental factors that influence currency values. Fundamental analysis complements technical analysis and helps traders make informed decisions based on a comprehensive view of the market. It provides a foundation for developing effective trading strategies and managing risks. That was a quick introduction on the basics of Forex. We'll now move on to the basic characteristics of Forex contracts. Well, firstly, the Forex market is a bidirectional market. In the earlier example, you view that the euro will strengthen, so you'll buy the rate first. However, if you think that the rate is going to drop, you can sell the rate first and then buy back later. This allows you to trade both directions of the market effectively. With daylight savings, you can trade Forex 24 hours starting from Monday 5 a.m. Singapore time to Saturday 5 a.m. Singapore time. There is no trading during the weekends as the banks are closed. Hence, you can trade on your mobile through the app or at night when you have the time to monitor at your PC. There are various contract sizes available to adjust the risk exposure according to your requirements. In the earlier example was a $10,000 contract size, which is what we call the mini contract size. Per pip of this movement on the mini contract size is $1, and a big movement of 100 pips would be a $100 movement. If you think that the size is too big for your appetite, you can scale it down to the micro size of a 1,000 per contract, which is 1/10 the size. For a 100 pips movement, that will only be $10. So there's a comfortable size for every trader, and new traders can start with a smaller size to familiarize with the platform and trading. Subsequently, you can decide to pick a reasonable size and can do any multiples of micro or mini or even the regular sizes. All the margin is in US dollars. So margin required is 5% of the contract value. For 10,000 contract size, you do not need to come up with the full value of 10,000, but merely a 500 euros, which is roughly about 546 US dollars. So with this amount of money, upon using leverage, you can get started with mini contract sizes. If you wish to do even a smaller contract size, like the 1 micro size or the 1,000 contract size, that will only be 54 US dollars. This is a leverage of only of 20 times, which is standardized across all contracts. So if you don't come up with the full value, but only 5% of the margin, you are able to start the contract. Due to the leverage, if the market goes against you, you need to top up the account to meet the margin call. If the margin drops to a low enough level, your positions will be liquidated by the system to avoid overloss. We'll explain these details in our next coming slides. There's also no expiry date for the contract. This means you can hold the position as long as you wish, but take note of swap that you may incur or gain for long-term positions. Basically, when you hold positions overnight past 5 a.m. Singapore time, you might need to pay swaps for it. You can avoid this by doing intraday trades and closing the position before you go to bed. So here are some of our major forex pairs that are popular among forex traders. We have euro dollar and pound dollar, which are the European pairs. These are moderately volatile. If you like a pair that is less volatile, you can trade the Aussie dollar or the dollar yen. Dollar Swiss is another very volatile pair. So if you are trading European pairs, you need to follow the economic data and political events that are happening in Europe and UK. As the pairs are versus the US dollars, you also need to follow monetary policy in the US, which will affect the currency movements. We'll discuss more on it later on. Listed are the margin required for these various sizes as shown. So depending on the contract size you're exposed to, the margin requirement is different. Take note that you do not have to come up with the full value of the contract, but merely a percentage, 5% of the actual contract value. I hope you're following so far. We'll move on to the calculations on Forex trading. Shown here is the Aussie dollar bid and offer spread. As you can see, the spread is very tight with fractional pip spread of about 5 to 6 pips. So the contract size in this example used is the 10,000 Aussie dollar contract. To start this contract, you only need a margin of 335 US dollars in the trading account. You can deposit these funds in Sing dollars, but upon deposit, as this is a USD based trading account, all funds will be converted to US dollars. The smallest tick for, or pip we call it, for the forex trading is 0.00030 M11. That is equals to 1 US dollars for the 10,000 contract size. To start a contract, you can choose a direction. So when you buy Aussie dollar, or this is the same as saying that you're long the Aussie, you're basically selling the US dollars, which is the opposite currency. So if you decide that the rate will increase, you go in and buy 10,000 Aussie dollar at the rate of 0.6704. Then subsequently, when the rate rises 10 pips to 6714, you can sell it back to the market. This will be a gain of 10 pips, and since 1 pip is equals to $1, 10 pips will be 10 times 1, that is equals to 10 US dollars. Now in your account will be topped up with the realized value of 10 USD. So meaning to say, if you had 335 US dollars in the account, it will now display 345 US dollars. So for the MP5, it's a zero commission trading account, and you do not have to worry about any commission charges, but to take note of swaps for overnight trades. We'll move on to another example when the market moves against your position. In this example, we are looking at the euro dollars and the bigger contract sizes, which is the 100,000 euro dollar contract size. For this contract size, the margin required will be 5,530 US dollars, also a 20 times leverage. Now this time, the smallest pip, 0.0001, is equal to 10 US dollars, as the contract size is 10 times bigger now. Now, assuming that you have $6,000, more than sufficient funds of one regular contract size margin of $5,530. With this excess funds, they can be used to cover any top-ups or market movement that's going against you. So when you buy the euro, you're same as selling the US dollar. And let's take, for example, we buy 100,000 euro dollars at 1.1055. Now, this time at the end of the market, there's always a settlement price, but you have not closed out your position yet. It will be marked to the market throughout the day, based on, and also at the end of the settlement price of 1.0955. In this example, this drop in the number of pips is 100 pips against the direction of your position. Since one pip is now equal to 10 US dollars, the total amount of loss is $1,000 pips, or 1,000 US dollars. As you had $6,000 USD in the account, using an unrealized loss of $1,000, you are left remaining of 5,000 US dollars. Notice that this amount is less than the amount required for one contract for 5,530 US dollars. Hence, there is a margin call of $530 to be topped up. Now, you will receive this margin call via emails from us throughout the day when it drops below the margin level of $5,530 for one contract. You can choose to top up to eliminate margin call so as to be safe that maintain the position as long as you want. However, you can also choose not to top up, and if the margin goes lower later, it will be liquidated when margin is low at 20%. We'll take a look at the example of the 20% margin scenario. Using the same example, we have a $100,000 euro contract size as from the previous slide. The order cut will happen at 20% of the initial margin required. So that will be 20% of the margin requirement of $5,530, giving us the minimum margin of 20% of 1,106 US dollars. So meaning to say, when the funds in the account has dropped to a low level to reach 1,106, all your position, in this case only this position, will be liquidated at 20% of the margin. This will mean that will be a depletion of a total funds of $4,894, and you have realized this amount of loss, and the amount of funds that's remaining is 1,106 US dollars. This is a drop of 489 pips from the entry rates of 1.1055 as it reaches 1.0566. Now we'll move on to the second part of our webinar, discussion on the tariffs and the impact on currency markets. So first of all, tariffs are taxes or duties placed on imported goods, often used by governments to shield domestic industries from foreign competition. In the case of the US, imposing tariffs is typically aimed at reducing reliance on imports and boosting domestic production. When these tariffs are enacted, the imports may decrease as the high cost of the foreign goods discourages consumption. This prompts consumers and businesses to seek domestic alternatives. This reduction in imports can help narrow the US trade deficit, which is what Donald Trump wants. The gap between the value of what the country imports versus what it exports. A smaller trade deficit implies that more money is staying within its domestic economy, which is the US economy, rather than flowing overseas. In theory, this actually strengthens the US dollars, as improved trade balances are often seen as a sign of economic resilience. However, in actual fact, we are seeing the opposite of what is happening. That is the weakening of the US dollars. This is because what follows up after the impose of these tariffs are retaliatory tariffs by most countries, major trade partners like Eurozone, the Eurozone, Canada, as well as the Asian countries. So trading partners may respond by placing tariffs on US exports, reducing the competitiveness of American goods abroad. If foreign demand for US products drops due to higher costs or political tensions, US exporters may suffer, possibly offsetting any gains from the reduced imports. So these global supply chain disruptions, right, hurts competitiveness as well as impact both imports and exports. On the impact on currency markets, If traders believe tariffs will successfully and improve the trade balance, bolster domestic growth, the dollar can appreciate. However, what we're seeing is that tariffs are actually leading to retaliation, trade wars, or even slower economic growth. Hence, the dollar is actually weakening. So investors seek more stable or growth-oriented currencies. So whoever actually imposed tariffs will see a weakening of their currencies. Remember this idea when we are looking at the different examples of various currencies later on. Next, we look at market sentiment and risk aversion. Tariffs announcements, especially those that are abrupt or unexpected, can send ripples of uncertainty throughout the markets, especially so in the Forex markets recently. So investors actually view all these signals as geopolitical tension, which is a slowdown in the global trade. This can lead to a risk-off sentiment where investors become more cautious, pulling back from volatile or uncertain markets. This will also mean that there's capital outflows shifted towards safer assets. During times of uncertainty, investors try to flock to safe haven currencies, um, like Japanese yen and Swiss francs. So these currencies are historically viewed as stable compared to the US dollar after the US dollar. The US dollar can also act as a safe haven when political instability does not impact the US economy. However, in this case, US is the central player in these trade conflicts and the one that's imposing tariff war. Hence, we see a weakening of the US dollar. Next, we look at the impact of tariffs from inflation expectations. So, when there are tariffs, foreign goods become more expensive due to tariffs. Importers will pass this cost to consumers in the form of higher prices. For businesses relying on imported components like raw materials or production costs can increase, potentially also leading to higher prices. This creates a cost push inflation, which is a situation where prices rise due to the cost of production rather than increased demand. Inflation expectations are what consumers businesses expect the inflation to be in the future. If markets believe tariffs will sustain inflation, central banks like the Federal Reserve will feel pressure to tighten monetary policy by raising interest rates to keep inflation in check. Higher interest rates can attract foreign investment, potentially strengthening the domestic currency. However, this isn't always straightforward and is a delicate balance between growth of the economy and inflation. That is what the Federal Reserve is trying to do now, running a very thin line of balancing act between raising interest rates or down, downsizing the interest rates, because there are two forces that's driving the situation currently. Raising rates could fight inflation, but this will slow down the economy. Keeping rates low may support growth, but allow inflation to rise. So there's a dilemma here. And this dilemma has caused significant volatility in the Forex market as traders try to anticipate what risk the central bank will prioritize first, whether it's inflation or to support the growth in the economy. If markets believe Federal Reserve will respond to rising inflation with rate hikes, the US dollar can strengthen. However, if traders expect the Federal Reserve to cut or hold rates due to weaker economic growth, US dollars can continue to weaken, as this signals a drop in confidence in the US economy. Central banks' reactions are the fourth factor that influence currency markets. So central banks influence the forex markets by a business sentiment. Tariffs can increase uncertainty for companies engaged in global trade. Also, consumer behavior. Higher import costs can reduce consumer purchasing power, hence slower spending. Thirdly, inflation. Inflation can cause tariffs to push up prices, or weaker demand may simultaneously exert downward pressure. So there's two scenarios that the Fed can can take. In a dovish scenario, the Fed can lower interest rates to stimulate the economy. Lower interest rates will weaken the US dollar. For a hawkish or neutral stance, if the economy shows resilience despite all these tariffs, i.e. strong job market or steady inflation, Fed may maintain or even raise interest rates. As seen from the last US-China trade war in the first term of Donald Trump, when the tariffs are escalating between the US and China, the US dollar initially strengthened due to a flight to safety, as investors move away from riskier assets. However, as the trade war was dragged on, volatility spiked and concerns about global growth emerged. The Federal Reserve responded with a series of rate cuts in 2019, citing global headwinds and trade tensions. Of course, after that is COVID, which follows the path of a series of rate cuts, ultimately weighing on the dollar later in the cycle. So we can see that in the forward path, the Federal Reserve is actually most likely to cut interest rates if the economy is going to slow down. We'll take a look at the timeline of what happened for the Euro and US tariffs. Excuse me. So it started off in February 2nd, when President Trump signaled his intention to impose tariffs on the European Union. 2 days later, on February 4th, Euro trade ministers they met in Warsaw to discuss how to respond. And on the 7th, they imposed lower car import tariffs from 10% closer to the US rate of 2.5%, increasing the purchase of American LNG. Then, on February 10th, the US continued, despite this reaction from the European Union, the US officially announced a 25% tariff of imports on steel, aluminum, and related products. Fast forward to the March 12th, the Eurozone responded with a two-phase retaliatory plan targeting 26 billion euros worth of US goods, scheduled to begin on April 1st. On March 27, US escalated things by imposing a 25% tariff on all car imports, hitting Germany especially hard, given that it exports a lot of cars. On April 2nd, coincided with Liberation Day, Trump announced a sweeping 20% tariff on all EU imports to take effect on the April 9th. In response, April 7, EU offered a 0-for-0 tariff agreement trying to de-escalate the situation. But on April 10th, President Trump continued to announce President Trump decided to announce a 90-day pause on the full tariff implementation. While most EU tariffs were reduced about 10%, tariffs on steel, aluminum, and vehicles remain in place. Moving on to April 14, EU published its own countermeasures targeting US tariffs, but opted to suspend the implementation for 90 days. A day later, the EU finalized a 25% tariff package targeting 18 billion worth of American goods. Finally, on May 8th, they announced a huge broader retaliatory package, nearly 100 billion euros in US imports. However, this has not taken place yet and due to the 90-day suspension. This is the timeline so far. As you can see, it started off with an escalatory stance, but currently in a suspension stage. But we will see the impact on euro and the pound dollar later on the charts. Before that, we just look at the timeline for China and US tariffs as they happen concurrently. So it started off with the US with 10% tariff on the Chinese imports that officially took effect. 6 days later, China hit back with 15% on coal, LNG, crude oil, and agricultural machinery. On for the March, the US raised tariffs on the Chinese goods to 20% in retaliation. The very next day, China responded again with more tariffs, 50% on agriculture products. Then on 2nd of April, President Trump announced that the Liberation Day he will impose a hefty 34% tariffs on all Chinese imports starting 5th of April. China quickly responded once again on April 4th, matching a 34% tariff, tit for tat. On April 7, Trump threatened to ramp up this tariff to additional 50% if China didn't roll back. Next day, US immediately imposed a cumulative 104% tariff on China's imports. China retaliated, raising tariffs of US imports to 84%, effective April 10th. On the same day, Trump announced a 90-day pause on the full tariff implementation for most countries, reducing reciprocal tariffs to a baseline of 10%, but not on China imports, which increased to 125% instead, citing that China has retaliated and showed disrespect in negotiations. China matched that move once again on April 11, increasing tariffs on US goods to 125% on April 12. Finally, after 40 days of rapid escalation, on May 17th, US-China agreed to drastically reduce their tariffs down to 30%, and for China is 10%, with a 20% on fentanyl. So this is a timeline for both the US and the Euro reaction to US tariffs, which is what they are both the main trade partners of US. As you can see, initially there was an escalation of tariffs, and we are facing a suspension, a 90-day suspension. First, we look at how tariffs impact the forex markets. For Aussie dollar, well, it depends on global trade for Australia and mostly on China. So it looks more into the China-US trade relations. When there's US-China tariffs ongoing escalatory tit for tat, we see a downwards pressure for the Aussie dollar. As you can see, that when it went to 125%, Aussie dollar plunged pretty low, even breaking some major support levels of 0.6 psychology level. However, soon after that, when Trump came out on April 8th, which is somewhere around this blue rebound of the Aussie dollar, you can see that Trump came out and say that excuse me, say that China and US is arranging for a meeting for a trade deal very soon. Based on that rumor alone, the market recovered. And after that, true enough, they actually finally met in Swiss and they managed to have 90-day suspension. And that's where we are at right now. Next, we look at euro dollars. So for the euro dollars, tariffs on euro goods have been announced for the past few months, and euro has been adopting a cautious approach to reciprocate, partly also because they are actually a union of many countries and needs time to actually make the calculations. So it's not until recently, which is last week, that they started announcing the reciprocal tariffs. During this period of time, as you can see, it was a one-way direction for the euro dollar, which is a weakening of the US dollar. This is because the euro did not retaliate for this period of time, and it was merely the country that announces its tariffs that depreciated its own currency. However, as the tariffs were off, you can see a retracement of prices after that. Not really off, but a suspension of about 90 days. You can see a downward retracement of prices. From last week onwards, Euro has also announced its 100 billion tariffs at the end of the suspension. This caused the retracement to be sustained, and currently we are on a short-term downside. But Donald Trump has said once again in 2 to 3 weeks' time, if there were no trade announcements, he will actually raise the tariffs back to the level that was previously set. For the European Union, that would be probably 20% or even more if it does change his mind. So we are expecting huge volatility. If that announcement comes out, the euro dollar may continue to go for an upside push. Now, for the pound dollar, this is a slightly different scenario because in the European dollar, there's a retaliation. For the UK, so far he has not shown any retaliation. And moreover, UK has a surplus with the US. So tariffs on UK goods is most likely expected to stay at 10% at this point in time. Hence, the pair is most positive towards the upside for the pound dollar pair, which is a depreciation of US dollars, as this is a one-side implementation of the tariffs by the US dollar, of a US country. So you can see there's a push for resistance over here and likely to go for the higher level of resistance if the tariffs is to be implemented once again in 2 to 3 weeks' time. For the dollar yen, it has always been dependent on the US and has not retaliated as well so far. So the downside momentum should carry on with the baseline tariff of 24% or higher than other countries at 10%. However, Japan is actually in request for a lower tariff rate, with the US holding the reins for the tariff. US dollar is expected to continue to weaken, and the pair might test lower levels. However, recently some GDP data, economic data from Japan has caused some worries in the markets and led to some depreciation in the currency. This is shown by the rebound of the dollar yen, which is depreciation of the yen currency due to weak economic data. In a nutshell, Japan's economy shrank for the first time in a year at a faster pace than expected, from 0.02% drop expected to 0.7% annualized drop from the period of January to March. However, it is seen that the weakening of the dollar may resume and test a support level over here once again. Having touched on the four major pairs, we now proceed to the platform demonstration. So you can actually trade MT5 on your mobile phone or on your desktop PC. We'll be conducting this demo on the PC version. This is the platform I installed on your desktop PC. From the menu, you can log into the trade account by clicking on the log into trade account. And with the password provided with your demo account or live account, you can click OK and log in. Next, the watch list is shown on the left over here. The first thing you want to do, of course, is to add in the symbols or the pairs that you're interested in. By opening this view under view symbols, you'll be able to see this menu to add in the contracts that you want. They are categorized in different categories. So for Forex is a major category. You can select classic, and those that are highlighted in color code in yellow, which means that the contract has been selected and added to the watch list. For example, this pair is not highlighted. It has not been added and can be done by double clicking on it. Similarly, with another double click, you can remove it from the watch list. Just click OK, and this will update your watch list with the contracts that you desire. Well, you can also trade from the trade menu by right-clicking on the pair that you want to trade and select trade. Or simply by just double-clicking on the pair itself. This will bring up the trade menu. Right, there are two types of market orders and two types of orders, which is the market order and the pending order. This is shown as exchange execution for the market order, and the queue for the price is the pending order. Select the pending order, and you can select the buy limit or sell limit depending on which direction you want to take. Key in the price that you want and the size that you want to go into. For example, if you go for a smaller size, the smaller size available is 0.01. For beginners, this will be a good place to start. You can key in the price that you wish to enter. For example, in this case, let's say you want to enter at 6,400 below the market price currently, and I'll place this trade. Once you have entered the trade, it will be in queue, and this will be shown below the margin level F1. In this trading account of the demo account, we have 130,000 US dollars in the account, and the margin required for this is very small, so about $50 or less. So the market will actually execute this order when the price comes down to 64 level, which you have set. Currently, it's trading at 64 at 1.4. To cancel the order, simply just click on the cross button to cancel it. If you like to do an order immediately, you can click on the market order exchange execution order type, which is the first selection. Simply click on buy, and this will execute at the market price shown here. For a buy order, it will be 64149. For a sell order, it will be 64140. I'll proceed to do with a sell order. So you can see this is a regular size with a 1.0 volume, and there's no commission, and the only difference is the entry and exit price that will determine your profit or loss. So currently, due to the spread, for a regular contract size is much bigger. Once you cover this spread and the number tends from negative to positive, you can close off the trade for the profit. To install a stop loss or target profit, you can double click on this empty space underneath the column, and this will be able to let you set the profit and loss accordingly. For example, since it's a downside direction that you're looking at right now, if the market has dropped down to 640, 0.640, 6400, you can set it to take profit. You can also set a stop loss orders if it rises to 6440 instead. So having set the stop loss levels as well as the take profit level, notice that this is a modification of this specific order ID and tagged to this specific position. So once I set it, you can see the values being shown here in the stop loss and target profit. You can have multiple positions of the same contract size in different positions, even if they are opposite directions. Meaning to say, you can have an Aussie dollar long position and at the same time have a sell position in Aussie dollars to hedge the position. So as is a zero commission platform, once you see the blue figure, you can proceed to close out the trade. For intraday trades, there are no swaps incurred. So any long-term positions carried forward past 5 a.m. Singapore time, expect the number over here to show a positive or negative number depending on the direction of the market that you are in. So it's always if you do not see the swap column, we can right-click on the title, click on columns, and select check the swap box. So this is especially useful and it's advisable to keep this column here to monitor positions. So trading can also be done from the chart itself, right? You can go to the Aussie dollar chart. As you can see, it shows a position that you have set previously, and you're now at sell at 0.64137, which is this position. Well, if you like to place another trade, you can do so from the chart as well by right-clicking and clicking on Trading Man. This is a place where the price level that you should click on the chart, and you can do a sell limit. As this is currently above the market price, the order is not done and is in queue. When the market rises to this level from 0.6412 to 0.6653, this will execute the position. I will remove the order for now. So to close out the position, simply just click the cross button to close. However, you can also go to double click on a position or anywhere else in the market order and click on the yellow button. Do not click on the sell or buy button, as doing so will actually initiate a new position and you end up with two positions instead. So for closure of position, always look for the yellow button, and this will also state the closure direction. So to close this market, ticket ID number of 484901, which links to a position over here. So once confirmed, simply click this, and this position is closed. Once closed, the profit will be credited immediately to the trading account, and you can see there will be increment of the profit into the trading account. So this is a quick demo of this platform. If you require a demo account, feel free to sign up via our QR code later on that we shared. So I've always come to the end of the webinar. We hope that you found the info useful. Let me just touch on the available services offered by Affiliate Capital. If you sign up for the account, which is available online using my QR code we will show later, I'll be providing WhatsApp economic data updates every week. There will also be technical discussions on the trades, and I'll be assisting you with any questions pertaining to your account for trading. I will cover markets on Forex, global indices, precious metals, etc. So MD5 is actually available to trade on the go on the mobile phone app, as well as the desktop PC version. As mentioned, this is actually a zero commission based platform, and you enjoy 24 hours trading wherever you are when you want from Mondays to Saturdays. Also, there will be trade signals provided with acuity signals which can be downloaded to your desktop version of the MT5 platform. So as mentioned, my personal service includes WhatsApp economic data services, and there's also a free one-to-one coaching session if you wish to do that. This will be conducted for the technical analysis and also a run-through of the platform if you require assistance. For the Trading Central research portal, our in-house analysts also email technical reports to you once you sign up the live trading account. This will be suggested levels for your references for the different markets, such as the entry and exit levels, and this will be sent via the daily trading highlights showing directional views On the following pairs, we have euro dollar, pound dollar, dollar yen, Aussie dollar, dollar candy, dollar sing, and also the spot gold, which is also available on MT5 trading platform. We also have the fundamentals covered for those who do not have time to search for this on the internet. For the fundamentals, they are sent as complimentary reports to give you updates on economic views happening around the world. Hence, we provide both the fundamental and also the technical aspects of trading, and the rest is up to you to decide for the trading. Besides the analyst report, if you have any questions about the market or your account, you can also reach out to me as well. So, to open an account is very easy. Simply scan the QR code shown here on the left. Trading Forex on the MD5 is commission free. Intraday trades do not incur any swaps. If you're interested to get started, feel free to scan this QR code and open a live trading account with us at no cost. There is a very low entry level. You can start with a very small position with margins as low as less than $100, 50 to 100 for each micro pair. You can also upsize the contract whenever you feel comfortable and that your strategy is doing fine for you. With a if you have a very small amount of margin, you can start live trading account in no time. If you have been thinking of opening an account trying to trade on Forex, this is a good time because we are actually looking at a directional move in the Forex market, which we are seeing a depreciation of the US dollar in the very long term. So you can get started with the account first by starting with a live trade account and just fund whenever you're ready when you want to trade the live account. There's absolutely no admin fee and any cost in maintaining the account. The process is very easy via SingPass and can be done quickly within minutes. Create an ID by scanning the QR code. The link will be tagged to me and I'll be assisting you when you open the account. Alternatively, if you want, you can use the QR code later on for coaching session. So foreigners are also able to use the QR code to open the account. Excuse me. And these are the QR codes available. If you wish to sign up for a demo account, feel free to scan the QR code on the left. So we have come to the Q&A session, and let's try to answer some questions. Okay, the first question. Is there any platform fee imposed on the live account? There's absolutely no platform fee or maintenance fee when you open a live account. Once you open an account, you can fund the account anytime you want when you wish to start trading. But the advantage of it is you get access to live prices immediately, and you're able to see the swaps that incurred as well. Alternatively, if you want to you can do the demo account, which is absolutely free, just simply by scanning this QR code over here for the demo account on the left. For the live trading account, you can scan the QR code on the very right, shown here. I'm not scanning it. For the coaching session, it's absolutely free. So you can actually scan the QR code for a coaching session if you want one for the demo on the technical analysis of certain pairs and how to go about the MD5 platform. This can be conducted at our office or online via Zoom. For the minimum amount that is to open a trading account is there's no minimum amount. Simply just scan the QR code and open an account first. And the minimum amount depends on what you wish to trade in. So I would suggest probably putting in a few $100s to start off the trading account. And you can start off with the smallest contract possible, which is the micro lot size. So before you go, thank you for attending the webinar today. We appreciate you for joining. If you find this session valuable, we'd love to hear from your feedback. Please take a moment to leave a 5-star Google review by scanning the QR code on the screen. I'll leave this screen for a couple of seconds. And after that, I'll be showing you the QR code again for the demo account if you so wish to sign up, and also the live trading account. So I hope you have scanned this QR code for the Google, and your insights will help us to improve and reach more professionals like you. Don't forget to mention my name if you require any services that you have received. Thank you for the support. All right, that's all that we have for today. Feel free to drop me a message or email if you have any questions. Here are my contact details. And thank you for so much for being a wonderful audience for tonight's webinar. A link to this recording will be sent to you via email from tomorrow onwards. If you have any query on the webinar, just feel free to get in touch and simply reply to the email. This is Hyogan. Thank you once again. Have a good evening ahead.